Welcome to another episode of Stately Investing with your host, Burnett King. If you like the content I'm putting out there, give us a thumbs up. If you love the content I'm putting out there, give us a subscribe. It really helps the channel. If you have any questions, feel free to leave them in the comments section or send me an email at statelyinvesting@gmail.com. And let's get started with the show. All right, everybody. Today we're going to be talking about dividend cuts, what you should do after a dividend cut, what companies are cutting their dividends due to the coronavirus, and can you predict when dividend cuts are happening? One company says it can. So we are going to first start off with the recent dividend cuts. So if you look at this news article, 23 dividend cuts and suspensions chalked up to the coronavirus. This article was put out a few weeks ago. And essentially what's happening is a lot of businesses just aren't generating revenue, right? A lot of things are closed, although they're starting to reopen up in the US. And they don't have the revenue to sustain a dividend, due to a lot of reasons. They didn't save cash, or they spent a lot of cash on buybacks, or they've been paying out these expensive dividends to their investors, right? And I am one of those investors who is interested in dividends and getting returns off of investing in their company. And so when they're looking to stay in business without generating revenue, they got to start cutting expenses. And so if they can cut dividends and get away with it, then that is one area a lot of companies are looking to save money on for their future. So we're going to look at dividend cuts, recent ones. And if you'll notice, a lot of these companies are in like travel or retail related industries where things are just shut down entirely. So the first one here is Dick's Sporting Goods. They've essentially suspended their dividend. So that's a little different than an actual dividend cut. What they're saying is they will suspend their dividend for a portion of time. And then after that portion of time is over, they plan to restart their dividend, most likely at the same level it was at before. So this is just a temporary pause, and it enables them to save cash during that period of time. And so that's a slightly different than a dividend cut, and generally a better predictor of you might want to stay invested in that company because they're not actually cutting the amount of the dividend. So the next one here is Estee Lauder. Again, that's a dividend suspension. Makeup, retail, right? Makeup especially, people aren't really spending money on makeup during this time, but this should probably come back around as things start to open back up. You can see Gap, again, it's a dividend suspension. Retail, Gap has been hurting for many years in general, and they just cannot sustain a hit like this. And so they need to figure out ways to save money. Carnival, another primary example of what happens when global travel just stops, and especially leisure activity like cruises. And so it's probably been one of, as it says here, no industry has been more affected by COVID-19 than the three major cruise companies. It probably will turn around, but something that's along those lines. AMC Entertainment has actually cut their dividend, right? So these are movie theaters. Again, nobody can kind of go to the movies, even in the reopening phase. Most places aren't allowing movie theaters open. So that's going to take a long time to recover. You can see like Goodyear, tire and rubber. I think so. This is dividend suspension, which means they're just like cutting their dividend altogether. So that is something that is a very bad sign, and generally it's because of a bad balance sheet or something going on with the company where they owe a lot of debt and they have to take out more debt in order to keep paying the dividend. Then you have some oil industry folks. A lot of these companies are in industries where there is related to travel, retail, entertainment, oil, things that are affected when the globe has shut down, consumerism. So one of the biggest triggers, right, you can see here is Shell. So with this article in Seeking Alpha talks about how if Shell cuts their dividend, are other big oil players going to cut their dividend? Oil's been in a crazy downfall over this, even before coronavirus, and it's continuing through coronavirus. The demand is just not there, right? So And people thought, Shell was one of the biggest companies that wouldn't cut their dividend, because it's such a huge company and has some reserves to play with. But they have cut their dividend. So then the question is, does BP follow? Does Exxon follow? Does Chevron follow? Right? If Shell can cut their dividend, can these other ones do so as well? And it shows you the yields, right? So as this yield goes up, that generally means their stock price is falling, and then it comes back down here. And so, Dutch Royal Shell decided to cut their dividend. Another one here is MGM Resorts, right? They cut their dividend by 98%. 98% is huge, right? That basically means there is no dividend. They didn't get rid of it entirely. That's probably to kind of preserve their stock price a little bit. But you can tell that, the casino industry has just been decimated by the news. People just can't spend. Basically, revenue in certain locales like Macau, China has gone to zero. So that means, they don't have any revenue. They can't support these dividends. They have to do something. So what I recommend in a dividend cut situation is really, if one of your companies has cut their dividend recently, look at their balance sheet, and also take your gut instinct into play, right? Do you think this is an industry that will recover quickly once things reopen, or has the potential to raise their dividend again fairly quickly, right? It might be a really good time to buy because that stock might be growing here in the future, in price at least, if not dividend. Also look at the type of dividend cut. So is it a cut, like a numerical drop in the amount? Is it a pause, meaning it's going to come back at the same rate it was after a period of time? Or is it a complete suspension of the dividend where they're just eliminating it altogether? So I think those are the things you need to look at, is the type of dividend, action, the balance sheet, right? Do they have a ton of debt? Are they not going to be able to repay this debt anytime soon? That's probably something where you want to sell. Even if your stock price is dropped, I would say cut your losses and move on and find other places to invest your money. Or is it something that you think can recover? And that might just be something you want to hold on to, or invest more in potentially. The last topic we're going to cover today is, can you predict these dividend cuts? So one company says you can, right? Simply Safe Dividends. They're known for having this dividend safety score. And what's interesting is that they show, you can avoid 97% of dividend cuts if you follow their scoring mechanism, right? If you kind of look at their research and see how their scoring works, they're pretty accurate about predicting when a company might be cutting their dividend, and they have about 97% accuracy, right? So it says investors who stuck with companies that scored above 60, which is our safe and very safe categories, would have avoided 97% of the cuts, so 518 cuts, and this is since 2015 when they started their scoring system. So you can see, like, it kind of goes backwards in order here from May 1st backwards. It's showing what all of the companies that cut their dividend and what their scores were, and you can see they're pretty accurate, right? So a 29 for New Star Energy, a 27 for Weyerhaeuser, American Airlines, right? So all of these companies have cut their dividends, and you can see what their score is. So I know some other investors use Simply Safe Dividends to figure out what companies they should be investing in if they're in dividend growth. They have a lot of great research. The interesting piece of this is that it does cost money. So to get access to Simply Safe Dividends is $399 per year. I'm not sponsored by Simply Safe Dividends, but I think they have a great product. You can actually start a free 14-day trial, so you can get a feel for if their information is worth it to you. There's also a money back guarantee, and the price doesn't go up, right? So it tells you everything that's included here. You guys, I'll put a link in the comments below so you guys can check it out if that's something that you're interested in. You can start your free trial. You can even start your free trial and kind of pick your stocks, and then see if you like the research or not, and decide whether or not it's worth keeping for you. But overall, I think Simply Safe Dividends provides lots of great information for you. So I think that's going to be it for the video today. I hope you guys got some useful information out of it. If you'd like the content, make sure you tell a friend to watch the video, give me a thumbs up, and subscribe. I hope you guys are staying safe out there as this coronavirus keeps impacting our daily lives. And hopefully, you guys are staying strong with your investing strategy. And I look forward to talking to you again next week.